Okay, let's unpack this. Today, we're doing a really serious deep dive. We're looking into the blueprint of modern dominance. We're not really focusing on just one person, you know. It's more about the systems, the actual architecture that lets extreme wealth and power get built up, kept safe, and frankly, weaponized in the 21st century. The sources you pulled together give us this like rare composite picture of power. It covers everything from how tech is reshaping economies globally, all the way to these ruthless high-stakes games played in finance and boardrooms, really across different eras.
Exactly. It's more about the mechanics, not just a biography.
Hmm.
Our mission here is to get past the headlines, and really try to understand how dominance is engineered. We're going to look at four main areas. First, there's this geopolitical arms race and artificial intelligence. Then the rise of financial extremes, think LBOs, but also modern stuff like the LIBOR scandal. Third, we'll look at the kind of imposing ego and control you see with certain corporate architects like Gates or Jobs. And finally, how does all that extreme wealth concentration actually turn into real political influence? We'll touch on figures from the Koch brothers all the way back to someone like John D. Rockefeller.
So it's basically a study of strategic control, whether that control is over data, money, employees, or even political systems. It seems like it requires a founder or maybe a financier to successfully impose their own set of rules on the world around them. Let's kick things off where arguably the future is being decided right now, this competitive fight over AI and data supremacy.
Right. And when we talk about AI as the defining tech of our time, you immediately get drawn into this dynamic between the U.S. and China. What's really striking is how differently their basic strategies were seen, especially by analysts over here in the West.
Yeah, that initial misjudgment, that's a huge point in the sources, isn't it? Starting around 2014, China wasn't just sort of hoping for tech innovation. They launched this thing called the Mass Innovation and Mass Entrepreneurship Campaign. And this wasn't some small government thing. The sources describe it as a tidal wave of official government policy.
A real tidal wave, yeah. It involves setting up specific innovation zones,
Yeah.
creating these massive government-backed venture capital funds, and rolling out tons of incubator programs, all designed to steer capital and talent towards, very specific tech goals.
Mhm.
It was a huge top-down, state-sponsored push to essentially build or maybe buy a new advanced economy.
And the initial Western reaction, that sort of knee-jerk response to all this state-directed money.
Pretty dismissive. Yeah, commentators largely called it inefficient and misguided. They seem to believe that real innovation could only bubble up from, pure decentralized market forces. The thinking was that government getting involved would just stifle genuine creativity.
But that skepticism, well, it turned out to be pretty short-sighted.
Definitely. What the critics kind of missed was that this huge state sponsorship plus massive capital injections, it actually turbocharged the evolution of China's already unique sort of alternative internet universe. It let their giant tech companies rapidly close the gap, and in some areas actually surpass their American rivals, not just in making money, but in key capabilities.
And one of those key capabilities is their advantage in data collection, right? Which is just central for developing perception AI.
Precisely. Perception AI is, where the rubber meets the road, is the AI that sees, understands, and interacts with the real world, telling apart objects, people, environments. China's system gets this massive boost from it is relative openness when it comes to collecting public data.
You mean like all the CCTV cameras, the integrated digital payments, urban monitoring, that kind of stuff?
Exactly that stuff.
Yeah.
The sheer scale of accessible public data gives them a huge head start when it comes to actually implementing this AI.
So what does that data specifically fuel? What are the applications?
Well, it drives the really fast digitization of cities, of urban environments. The sources detail how this leads to new and, frankly, powerful online merge offline FOMO applications.
FOMO. Okay, break that down a bit.
Think about retail, where maybe your online browsing history starts dictating the experience you have in a physical store. Or think about security and transportation systems that are constantly learning and self-optimizing based on this live flow of data. They've managed to create this continuous live feedback loop of urban data that very few other places can match. And that lets their AI model train and get better at just an incredible speed.
Okay, so you've got state-sponsored money, a massive data advantage leading to unprecedented speed. That brings us straight to the consequences, doesn't it? For labor globally and for, well, rising inequality.
And this is where the story gets pretty sobering. The productivity gains we expect from this level of AI automating tasks, optimizing how companies make profits, they can be huge. but the job losses.
Right.
They won't just be in one sector.
Right, and this is a really crucial point that kind of flips the script on the old fear that it's only manual labor jobs going away. The sources are really emphatic. These layoffs aren't going to discriminate by color. Highly educated white-collar workers, the specialists, the analysts, consultants, they're going to get hit just as hard, potentially, as manual laborers or even skilled tradespeople.
And the reason is kind of simple, but also terrifying. AI systems are just incredibly good at spotting patterns, optimizing things, and making complex decisions at speeds and levels the human brain simply can't fathom.
Hmm.
So if your main job is finding trends, crunching large data sets, or making calculated choices based on known factors, well, an AI is likely going to be faster, more accurate, and cheaper pretty soon.
Which means, and this goes against decades of advice, right, that a college degree, even a specialized professional one like in law or accounting, it's absolutely no guarantee of job security anymore against these machines. It might buy some time, maybe, but if the core work is pattern spotting for profit, the machine's coming for it.
The warning in the material is quite stark. Looking back at, say, the Industrial Revolution and thinking, oh, things always work out, new jobs get created, that argument stands on increasingly shaky ground. The sheer scale, pace, and skill bias of this AI revolution are just so profound that those historical comparisons, they're starting to feel inadequate. The big picture trend, the immediate one, unless there are massive societal changes or interventions, is looking like rising structural unemployment and just an exponential widening of the inequality gaps we already see.
That intense, really systematic drive for profit and dominance, whether it's through data or tech, it seems to find its purest form in high finance. And here we see a sort of parallel trend, right? This move towards engineering complexity and extreme leverage to boost profits, often by deliberately pushing right up against the edges of what's legal or ethical.
Yeah, and this movement, its modern roots, really trace back to the 1980s with the rise of leverage buyouts, LBOs. We often talk about Michael Milken and junk bonds, but the sources point out that Milken himself thought the LBO structure was even more promising than just the bonds that fueled them. The really big money shifted into that struggle for corporate control, M&A, and this highly leveraged way of doing deals.
Okay, just so everyone's clear, an LBO, basically you're using a ton of debt, often raised through those junk bonds,
Right.
to buy a company. And the debt is secured by the assets of the company you're buying. So the target company essentially pays for its own takeover.
Exactly. It's financial engineering pushed to an extreme. And the scale just became staggering. If you look at the late 1990s, buyouts were usually only, 3 or 4% of all merger value?
Something like that, yeah.
But then 1988 happens, and the RJR Nabisco deal just becomes this behemoth. It was so huge, so massive in scale, it completely blew those overall numbers out of the water. It showed the terrifying amount of capital that could suddenly be mobilized for these corporate raids.
And the sources highlight the, frankly, outrageous internal planning going on. Ross Johnson, RJR's CEO, he saw this as his big chance for personal enrichment. He was planning what the sources call an unprecedented cut of the LBO's expected profits, taking it from his own partners at Shearson Lehman Hutton.
Wow, so the deal was already set up to be lucrative, but Johnson wanted this audacious personal slice off the top.
Exactly. It signals that maybe these deals were less about making the company more efficient and more about maximizing personal gain for the insiders running the show.
That structure, that focus on protection and maximizing returns, it gets even more refined when we move into the insider trading era. Look at the story of Stephen Cohen and Essex Capital. The goal seemed to be profiting from illegal info, while at the same time building these strong mechanisms to shield Cohen himself from direct knowledge or blame.
Okay, so how did they actually architect that plausible deniability onto the trading floor? It sounds tricky.
It's a fascinating, almost technical defense they built. While the firm was apparently steeped in this culture of insider trading, analysts were told to use a numbered conviction rating when they passed on their tips.
A conviction rating, like 1 to 10.
Exactly. So if an analyst had a great trading idea, but maybe the source was questionable or outright illegal, they wouldn't tell Cohen the illegal source directly. Instead, they just assigned it a high conviction rating, say a 9 or a 10. That signaled how sure they were the trade would make money, but Cohen never had direct, provable knowledge of the illegal information itself.
Ah, okay. So if the SEC ever investigated, Cohen could say, look, I just trade based on high conviction signals. I didn't ask why the conviction was high.
Ah,
The legal shield was baked right into the daily workflow. That's architectural, definitely not accidental.
absolutely. And the sources remind us this wasn't Cohen's first brush with this kind of thing. He'd taken the Fifth Amendment way back in the mid-'80s during the SEC's investigation into RCA-GE insider trading. It suggests a long-term, pretty sophisticated understanding of legal risk and how to manage it or layer it away.
Okay, so if SAC shows how to exploit private information, then the LIBOR scandal, that reveals a culture where just outright manipulation and lying were basically institutionalized business practice, a truly no-holds-barred environment.
The LIBOR scandal is stunning just because of the sheer scope of it. LIBOR, the London Interbank offered rate, it was supposed to be this honest, neutral average of what banks charge each other to borrow money. But the internal investigation at UBS found manipulation everywhere. It wasn't just one rogue trader, it was systemic, geographically spread, stretching from trading desks in Tokyo right back to high-ranking execs and managers in Zurich.
And the legal defense they tried to use tells you everything about that culture, doesn't it?
It really does. The brokers who got caught basically insisted their lies, like telling a trader, Tom Hayes, that they were rigging LIBOR for him, were just a ruse.
A ruse what? Like a joke?
They claimed they were just trying to con the gullible Hayes into giving them more trading business, not actually engaging in a criminal conspiracy to fix rates.
Yeah.
They were essentially arguing that deception is just how finance works. The core legal defense was literally that the financial industry is a no-holds-barred culture where things like transparency and honesty, they're not sacred. So fooling another trader wasn't illegal. It was just playing the game ruthlessly by the industry's unspoken rules. It normalized lying as just part of competing.
Okay, that really sets the stage for the ultimate power play, the 2008 crisis, where you see political maneuvering and government authority used directly to stabilize markets. It shows just how intertwined Wall Street and Washington are.
Yeah, you see Treasury Secretary Hank Paulson, who used to be CEO of Goldman Sachs, remember leveraging government power in these incredibly high-stakes negotiations. When Lehman Brothers was collapsing, he and Fed Chair Ben Bernanke were constantly on the phone. Bernanke specifically called Ken Lewis, the CEO of Bank of America, and urged him to consider buying Lehman.
And promised help if he did.
Promised a glide path for capital relief from the government if BOFA took on that massive risk. Direct intervention.
And then, when they needed huge amounts of money fast, without waiting for Congress, the sources reveal this, I don't know, brilliant or terrifying bit of political engineering.
That's right. Paulson, acting on advice from Steve Shafran, another ex-Goldman banker, turned to this really obscure old law, the Gold Reserve Act of 1934.
From the Great Depression.
Exactly. That act let the executive branch tap into something called the Exchange Stabilization Fund, which had grown to about $50 billion. Using this fund meant they could inject stabilizing money into critical markets almost immediately, basically bypassing congressional oversight. All they needed was the president's okay.
And the sources make it clear Shafran specifically pointed to this act as the quickest way to get liquidity flowing when every minute counted. It just shows that in extreme crises, the architects of power aren't just looking for the best financial fix, but the fastest governmental mechanism, even a forgotten law from the 30s, to impose stability and control.
Right, so it's clear these huge financial and tech systems are engineered. But let's pivot now to the individuals, the architects themselves, these singular personalities who impose these systems, often based on extreme control or maybe impossible perfection, onto their companies.
Yeah, these founders often get dominant, not just through great ideas, but through this unique mix of charisma and just pure, unyielding intensity. Bill Gates is a prime example. His demanding style, that really challenging approach, it was almost a point of pride.
His own father called it hard-nosed conversation engagement. Gates himself liked to call it high-bandwidth communication.
High bandwidth sounds efficient.
It implies efficiency, yeah, a constant, unfiltered flow of info. But in practice, for the people on the receiving end, it often meant surviving this relentless, intellectual, and sometimes emotional barrage.
And pursuing that radical vision, it had real costs, didn't it? Human costs, organizational costs. The original Windows project is a perfect example.
It really is. It was initially approved by Steve Ballmer for just 6 work years of effort.
6. That seems tiny for Windows.
Right. But the final project, driven by Gates, insisting on perfect features, perfect timelines, ended up taking an incredible 80 work years.
80, that's a huge difference.
A massive gap between the plan and the reality. And it caused immense strain inside the company. The sources talk about several hand-picked managers, key people, who just quit. They couldn't handle the screaming fits from both Gates and Ballmer as the project fell behind schedule and the sheer difficulty became obvious.
But what's so interesting is how that high pressure cooker coexisted with the famous microkids culture, right? That super casual vibe.
Totally. Employees often barefoot, wearing jeans, free Coke. It was only when, suits from out of town were expected that people would put on shoes.
And Gates himself, the sources say, he was so dedicated he'd often just crash on the floor of his office.
Yeah, exactly. This weird blend of chaos, extreme informality, but also impossible technical demands that really defined early Microsoft. Apparently, early on, colleagues sometimes thought he was just some random tech support guy wandering around
Until he opened his mouth.
until he started talking, yeah, and demonstrated this technical knowledge that was so complete, so credible, there was just no doubt he was the driving force behind it all.
Okay, then you have Steve Jobs. His pursuit of product perfection went way beyond intense. It crossed into the truly obsessive. Aesthetics and maybe emotional imposition were his key tools of control.
Jobs' perfectionism wasn't just about the software code. It was the physical thing itself. Working on the Apple II case, he apparently spent days agonizing over just the rounding of the corners. Mike Scott, another key early figure, just wanted a decision so they could actually build the thing. But Jobs was lost in the geometry.
And he extended that control to the workspace too, didn't he? The benches.
Oh, yeah. Setting up engineering labs, he rejected the standard kind of institutional gray workbenches. He insisted Apple special order pure white ones because for him, the environment had to reflect the purity and perfection of the product they were aiming for.
And that intensity, it could get really emotional.
Hugely. There's a story about arguing with Scott over extending the product warranty from 90 days to a full year. This was a financial decision, not really technical. Jobs got so worked up, so passionate about it, that he actually dissolved into tears during the argument.
Wow. And Scott.
Scott, probably just exhausted by the sheer emotional weight of it all, eventually gave in.
You can see why Jeff Raskin, who was crucial in starting the Mac project, famously said Jobs would have made an excellent King of France.
Right. He had that autocratic control, that personal charisma, and this totally unyielding vision needed to impose a kind of perfect reality, no matter the emotional or operational toll.
But when you combine that quest for control and supposed perfection with extreme secrecy, well, then you get the really dystopian results we saw at companies like Theranos.
Theranos created this almost Orwellian surveillance culture internally. The sources describe employees having to figure out strategies just to have a private life. Like Christian and his friends used different exits at different times.
Just to sneak out for a workout.
Yeah, just to elude Sonny's watchful gaze, as the source puts it. Their daily routine became like a covert op just to avoid management scrutiny.
And when the technology, the test results started failing so obviously, Elizabeth Holmes just used denial and technical spin as her defense.
Pretty much. When confronted directly about results being wildly inaccurate, she'd just dismiss them. Oh, those are just a few isolated cases, refusing to admit any systemic failure.
And the source material points out this really subtle dishonesty too, like with the coefficient of variation.
Uh-huh. That's a measure of a test's precision, its reliability.
Right. So when Theranos was pressed on their claim of achieving less than 10% CV, which is really good, Holmes didn't back down. Instead, the website claims were quietly shifted to specify that awesome reliability standard, it only covered the vitamin D test.
Which is just masterful, cynical deflection. It implies precision across the board while technically only claiming it for one specific test. That kind of technical deceit is chilling.
And then moving from chilling to just bizarre, you have the theater of the absurd at WeWork under Adam Neumann, where the founder's absolute power led to some truly strange, high-stakes potential decisions.
This anecdote is maybe one of the wildest in the source material.
Get this. Ramnick, who was one of the few quote-unquote grown-ups Neumann brought in for financial discipline, he had to step in on a potentially massive decision. Neumann apparently wanted to list the crypto token of a Taiwanese porn business called Swag.
Rick Swag, a Taiwanese porn business. Even for Newman, that sounds out there. What was the logic?
The sources suggest Neumann was just hell-bent on making FTX the crypto exchange. He was tied up with the main financial engine for this Taiwanese porn empire.
Seriously?
Seriously. Ramnick had to explicitly talk him down from it. It just shows, in these environments where the founder's ego and control are completely unchecked, you absolutely need some external force, a grown-up, to stop them from chasing ideas that could be financially, reputationally catastrophic for the whole company.
Yeah, the power structure was so warped that one person's whim, their obsession of the moment, could genuinely put billions at risk.
Mhm.
Okay, so let's pull back from these individual architects now and look more broadly at the societal impact. How does this kind of extreme wealth actually translate into lasting political and societal power? We can draw lines from modern data right back to historical examples.
When we talk about modern inequality, it's easy to focus on the gap between, the rich and everybody else. But what's maybe more revealing, according to the data, is the gap within the rich group itself. Thomas Piketty's work is key here.
Absolutely. The quantitative data is pretty stark. It shows that the growth of the top 1%, and even more so, the tiny top 0.1% that explains most, almost three-quarters, of the increase in the top 10%'s total share of U.S. national income since about 1970.
That's a really important distinction. So the story isn't just about college grads earning more than high school grads, although that's happening too. It's that the truly exponential takeoff of the very, very top incomes, the actual plutocrats, is quantitatively way more important in driving that overall shift in income share. It's like a battle for income share even among the highest earners, and the top 0.1% are winning massively against the rest of the top 1%.
And this concentration of wealth, it looks different in different parts of the world. In Southeast Asia, for instance, you find what the sources call Asian Godfather capitalism. It's described as this really entrenched system where the domestic economies are just too tightly controlled by governments to allow for many genuine, spontaneous, one-generation rags to riches stories. To succeed, you generally need to be close to existing power, get their explicit okay.
And the political clout these regional tycoons wield is huge and often pretty aggressive.
Look,
Look at Li Ka-shing in Hong Kong. The sources describe him making open threats to government officials and in public that he would pull his money out of Hong Kong if regulators even thought about acting against what he decided were the best interests of business.
that's just raw economic power, used as direct political leverage, right out in the open, to make sure the rules stay favorable. In his view, his interests and the government's interests are basically the same thing.
Meanwhile, back in the U.S. political arena, you see this incredibly strategic, systematized weaponization of wealth, especially through the operation run by the Koch brothers. They didn't just spend their own billions, they effectively created what the sources call a private political bank.
How did that work exactly?
They systematically went out and persuaded other very wealthy conservatives, people generally in that top 1.1% or even higher, to essentially invest their political donations with them.
Ah, so pooling the money for greater
Yes,
impact.
exactly. This structure let them gather and direct political spending power far beyond their own personal fortunes. It gave them this hugely disproportionate influence over policy debates and election outcomes.
And a key part of their strategy was pioneering the use of dark money. Right.
Yes. They funneled enormous amounts of cash into these secretive social welfare groups. These are nonprofits that can legally spend money on elections without ever having to reveal who their donors are.
So essentially, unlimited, untraceable money could just flood the political system, giving this select anonymous group of the super wealthy, massive, hidden, systemic influence over democracy itself. It's achieving control through darkness, through opacity.
And this modern, systematic way of achieving dominance, it really echoes the strategies used by the great tycoons of history. It proves that while the tools change, maybe AI today instead of oil back then, the fundamental goal is the same: achieving complete systemic control.
John D. Rockefeller is maybe the ultimate example of the implacable acquirer model. The sources note he actually preferred patience, preferred reason. But if he faced real competition, that wouldn't yield. He'd unleash extraordinary ferocity to force them into submission. This included really technical uses of his monopoly power to just strangle rivals.
How extraordinary are we talking? Like, what specific?
We're talking about things like cornering the entire available supply of wooden barrels, which were absolutely essential for shipping oil back then, or monopolizing the limited number of railroad tank cars. By controlling the logistics, the physical movement of oil, he could literally starve out competitors, paralyze their operations until they were forced to sell out to him at rock-bottom prices.
The scale of his dominance by the early 1900s is just shocking. By 1907, Standard Oil wasn't just big. It refined and marketed something like 87 to 89% of all kerosene.
Wow.
The federal lawsuit filed to break up his company, the Combine, was targeting an entity that was reportedly more than 20 times the size of its most serious competitor, Pure Oil. Just total dominance.
You see that same relentless drive for consolidation, for comprehensive control, with someone like Cornelius Vanderbilt in the 19th century railroad boom. That act of legislation allowing him to merge the Central Railroad with the Hudson River Railroad, that was a huge moment.
It created a single corporation on a scale never seen before.
Right.
And it basically ended the old fragmented system of New York railroads.
It's exactly. Before Vanderbilt, it was this messy patchwork of short, competing rail lines. His consolidation really solidified this trend of railroads operating as these unified, massive business machines driven purely for maximum profit. It helped usher in the whole age of the giant modern corporation. So whether you're looking at a 19th century railroad baron like Vanderbilt or a 2008 financial engineer like Paulson maneuvering government funds, or even today's AI arms race, the basic architecture of extreme power seems to always rely on successfully imposing control over some core system, whether it's data or logistics or political funding, and doing that while minimizing your own personal risk and exerting profound influence over the very institution that are supposed to regulate you.
It really does seem like the ultimate goal for every true financial or corporate genius isn't just about making money. It's about establishing a whole system, a set of operating principles that guarantees their continued success, often regardless of ethical lines. We've seen systems built on, like, hyper-efficiency Gates's high bandwidth communication, systems built on radical control, like at Theranos, and systems thriving in what looks like open market chaos, like with the LIBOR scandal. So, if the real measure of these architects is the system they manage to successfully impose, whether it's ethical or not, what's the moral obligation, then for the next generation, for the billionaire founders who are building the systems that are going to govern the global economy tomorrow, that, I think, is the question we'll leave you with today.